How the Federal Reserve works. If you have ever heard news reports about interest rates rising or falling, there is a good chance the Federal Reserve was involved in that decision. The Federal Reserve, often simply called the Fed, plays a central role in the U.S. financial system. Its decisions can influence borrowing costs, economic growth, inflation, and even global financial markets. Despite this influence, many people are not entirely sure what the Federal Reserve actually does or how it operates. It is not a typical government agency, and it is not exactly a private bank either. Instead, it operates somewhere between those two categories. So today we are going to walk through how the Federal Reserve works and why it has such an important role in the economy. Chapter 1. What the Federal Reserve is. The Federal Reserve is the central bank of the United States. A central bank is responsible for managing a country's monetary system and overseeing aspects of its banking sector. The Federal Reserve was created in 1913 after several financial crises revealed weaknesses in the banking system. Lawmakers wanted an institution that could help stabilize the economy and prevent sudden banking panics. The result was the Federal Reserve System, which continues to operate today as the country's central banking authority. Chapter 2. The structure of the Federal Reserve. The Federal Reserve is not a single organization located in one building. Instead, it is a network of institutions spread across the country. At the top is the Board of Governors located in Washington, D.C. This board consists of several members appointed by the President and confirmed by the Senate. Below the board are 12 regional Federal Reserve banks located in major cities such as New York, Chicago, and San Francisco. These regional banks help monitor economic conditions in different parts of the country. Chapter 3. The Federal Open Market Committee. One of the most important groups within the Federal Reserve is the Federal Open Market Committee, often called the FOMC. This committee is responsible for setting monetary policy, particularly interest rates. The FOMC meets regularly to evaluate economic conditions such as inflation, employment, and economic growth. Based on this information, the committee decides whether to raise, lower, or maintain interest rates. These decisions influence borrowing costs throughout the economy. Chapter 4. Controlling interest rates. One of the main tools used by the Federal Reserve is control over short-term interest rates. Interest rates influence how expensive it is to borrow money. When rates are low, borrowing becomes cheaper, which can encourage spending and investment. When rates rise, borrowing becomes more expensive, which may slow economic activity. By adjusting interest rates, the Federal Reserve attempts to balance economic growth with stable prices. Chapter 5. Managing inflation. Another major responsibility of the Federal Reserve is managing inflation. Inflation refers to the general rise in prices across an economy. Moderate inflation is normal, but rapid inflation can reduce the purchasing power of money. The Federal Reserve monitors inflation and adjusts its policies to keep price increases relatively stable. Interest rate changes are one of the main tools used to influence inflation levels. Chapter 6. Supporting employment. The Federal Reserve also considers employment levels when making policy decisions. In simple terms, the goal is to support a healthy labor market where people who want jobs can generally find them. If economic activity slows significantly, unemployment may rise. Lower interest rates can sometimes encourage businesses to invest and hire more workers. This connection between interest rates and employment is an important part of the Fed's decision-making process. Chapter 7. Regulating banks. The Federal Reserve also helps regulate and supervise banks. Banks play a critical role in the financial system by holding deposits and providing loans. The Federal Reserve monitors these institutions to ensure they remain stable and capable of meeting their obligations. Regulation helps reduce the risk of financial instability that could spread through the broader economy. Chapter 8. Acting as a lender of last resort. In times of financial crisis, the Federal Reserve can act as a lender of last resort. This means it can provide emergency funding to banks experiencing short-term liquidity problems. The goal is to prevent financial panic from spreading through the banking system. By providing temporary support, the Fed can help maintain stability during periods of economic stress. Chapter 9. Influence beyond the United States. Although the Federal Reserve focuses on the U.S. economy, its decisions often influence global financial markets. Because the U.S. dollar plays a major role in international trade and finance, changes in U.S. interest rates can affect borrowing costs worldwide. Investors, governments, and financial institutions around the world watch Federal Reserve decisions closely. This global influence reflects the interconnected nature of modern financial systems. To wrap up, the Federal Reserve is the central bank of the United States and plays a major role in managing the country's monetary system. Its structure includes a board of governors and 12 regional Federal Reserve banks that monitor economic conditions across the nation. Through the Federal Open Market Committee, the Fed adjusts interest rates to influence economic growth and inflation. It also supervises banks and can provide emergency support during financial crises. While the Federal Reserve operates within the United States, its decisions often influence financial markets around the world. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. Comment below what other topics you would like us to cover. See you in the next one.